Hello and welcome to today's FXTimes Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, May 6, 2010. Risk dominated the New York session today, especially from about noon in New York time as the markets capitulated to the financial troubles swamping Greece and the Eurozone. U.S. equity markets plunged with the Dow Jones off almost 1,000 points at one point, though it did recover some of those steeper declines to close 348 points down. All three major indexes were down more than 3% at today's close. Oil fell another 4%. To as low as $74.60 a barrel, though ending the day at 77.11. Gold, meanwhile, surged to 1,200 as it remained one of the few asset classes that investors are willing to put their money in on safe haven flows. U.S. Treasuries also saw a strong surge in demand, bringing down yields. There were rumors that part of the plunge was a result of perhaps a trading error, as a trader entered a B for billion instead of an M for million in a trade, possibly involving Procter & Gamble, but that has not been confirmed, though it has been reported by several news agencies. Still, markets were already down significantly on the day, as it seems that we have lost faith in EU leaders' ability to prevent a debt meltdown in Greece from spreading to other Eurozone countries and perhaps creating a global crisis. The fear and panic selling in the markets today did feel a bit like the plunge we saw in September and November of 2008 as investors and traders scrambled to protect their capital. Fears that there is no resolution to the Eurozone debt problems and the sharp losses to the euro are creating concerns about the creditworthiness and leverage of trading counterparties, which stoked fears of a looming crisis within the global financial system. That could mean a seizure in credit markets, and we saw part of that during the worst part of today's sell-off. In the currency markets, the capitulation to risk came in the form of the liquidation of long yen crosses. Here we're looking at the dollar-yen pair, and from top to bottom we saw a plunge of 590 pips, though we did see a bit of a recovery here, and we finished trading around 90.70. This is similar action to what we saw in the financial crisis of '08 as investors cut their carry trade positions. That is, when you buy a higher yielder and fund it using a low yielding currency like the Japanese yen. Zooming this pair out, we saw that we moved far below all of our recent supports here at the 92.80 level, and then our low for April at 91.50. And we actually wiped away most of this rally that we had seen in March, finally hitting a low back here from March 3rd. However, as I did mention, we did recover a good deal of this initial plunge, and we now trade near the top of this consolidation zone back in mid-March. But overall, you can see the volatility in today's market, as the gains that we had seen throughout 2 months were sold off in the span of a couple of hours. We saw a similar plunge in our other yen crosses. The pound yen, which is a favorite of carry trade, slid from high to low at one point, 1,200 pips. As we can see, that broke us below this consolidation zone we had seen throughout most of April, and our low even moved below our lowest we had been in all of 2010 here in late February. Moving to a daily chart, we have to look all the way back to February of '09 in order to get the low that we had reached today. Another pair that's a favorite for carry trade is the Aussie yen, and here too, very sharp plunge in the market from high to low, 800 pips, though we did recover about 1/3 of that decline with our close at the 38.2% retracement level of this fall for today. While the yen was the biggest winner today, the US dollar was also a destination for safe haven flows. Here we're again looking at the Australian dollar, though against the US dollar, and we see that after sliding in the last 2 sessions down to the 0.90 level, today we broke below that. And as our losses accelerated, we hit a support at the 0.87 level and rebounded like we did in some of our other pairs. This low for the Aussie dollar goes back also to what we had seen back here in early February. So just a very volatile and tumultuous day for risk aversion, and it's a very bearish sign for risk sentiment going forward. Let's take it the US dollar Canadian dollar pair, and as oil plummeted today, we saw the Canadian dollar, the US dollar go from around 1.03 all the way up to 1.008, which tested our highs back here in early February. If we zoom this pair back in, we did see a bit of a rounded bottom developing over the last couple of months. It's a little hard to pick out here, but we could just see that we did form a rounded bottom, and we had been climbing higher even prior to today's large rise, as we did have risk aversion knocking oil down sharply earlier in the week, and today we just had a surge as a result of the very volatile trading in the New York afternoon. The UK pound was down against the greenback as well, breaking out of its consolidation that we had seen throughout most of April with our support here at 1.5150. We had moved below that support earlier in the week and retested it in overnight trading, and it did act as very strong resistance. We have found support above the 1.50 level in European trading, and as we entered the New York session, but then as we had the sell-off in equities start, and around noon New York time, we saw the pound-dollar pair slide sharply. We also today are seeing voters heading to the polls for the parliamentary election, and there are fears of a possible hung parliament, and that overshadowed the currency as well. And it hit at low at 1.4720, and as we had exit polls coming in about the election, we saw the pair actually retest its low from earlier in the day around 1.4720. We now wait for Friday for a resolution to the election to see exactly how many seats were picked up and whether we could see a majority government, but it looks now that there will be a hung parliament. It seems almost like ages ago, but it was only this morning that the ECB held interest rates at 1%. And in the press conference following the ECB decision, there wasn't much in the way of new answers from ECB President Trichet. The recovery in the Eurozone continues. Expansion is expected at a moderate pace, but could be uneven, and money and credit growth is weak. When pressed on the tough questions regarding the current crisis, Trichet tried to avoid them, though he did say that the ECB did not discuss purchasing government bonds at the meeting, and that Greece will not default. He also gave a long and convoluted answer as to why Greek bonds were singled out for different collateral rules, and he said that Spain and Portugal are much different cases than Greece. Still, the euro-dollar hit a fresh 14-month low, just above the 1.25 level, and as we ended today's session, we were trading at 1.26. We now have to see what steps EU leaders will take in order to try to calm this crisis, but it seems that events have moved ahead of the EU leaders' ability to actually do anything. So we await some substantial comments from main policymakers or perhaps ECB officials. In the meantime, the threat of contagion continues to spread, and financial markets continue to be risk averse. In a final pair for today, we look at the euro versus the Swiss franc, and we see it plunging today. This was even before we had seen the plunge in the yen crosses, as it seems that the Swiss National Bank gave up its attempts to defend the 1.4320 level. The decline to 1.4220. This candle here happened in about a 15-minute span, and the pair continued to slide until we hit support at 1.40. If we zoom this pair out, we see that we had very tight range for the last 3-4 weeks, and today we just fell off a cliff as the SNB decided to stop intervening. So it was a very wild ride in the Forex markets today. So let's see what fundamental events will be upcoming, though at this point they may not have that much of an impact, at least in overnight. We get data from Switzerland, including unemployment change and retail sales. We get producer prices from the UK and industrial production from Germany. Tomorrow we do have the U.S. non-farm payroll report and unemployment rate, usually a very important fundamental event, so we'll see what kind of market reaction we have after today's very volatile behavior. Also at 7 a.m. in North America, we have the Canadian employment change. So that will do it for today's broadcast. We'll be back tomorrow to take a look at the non-farm payroll report, as well as any further developments in the risk appetite in the financial markets. So till then, visit FXTimes for more news, videos, and analysis, and thank you for watching.